Futures is way sexier than Forex. I could give you a couple reasons, but I'm only going to give you two. The first one is diversity of portfolio. I don't know, maybe it's because I'm from Miami and I'm used to having diversity around me. See, I can slide down to Little Havana, get my cafecito tostada para despertarme, or I could slide over to North Miami and get some authentic Haitian food, or Fort Lauderdale, hang out with my Jamaican friends, hang over in my beach with my Jewish friends, slide over to Homestead and get some authentic Mexican food. I mean, there's a lot of diversity when we're talking about Miami, right? And it's the same thing that futures gives you. They give you a diversity in what you can trade. You can trade commodities, you can trade currencies. What do you like? Metals? Do you want to find out about aluminum, palladium, all of the different things that we use in our everyday basis? A lot of them you can trade with using futures. And the reason why I like trading those versus just trading regular currencies is because you're able to talk about seasonal trading. Now, seasonal trading is amazing. I've talked about it before on Instagram in some of my videos, how you're able to use, for example, natural gas and just trade based off of the seasons. You know, in December, we know that it gets colder, and especially those of my friends up north, they start to pump up that heater, right? They start to use a lot more heat in their houses, and because of that, we see natural gas prices rise. The same thing with during the seasons of summer, for example. We're gonna see a lot more volatility when we're talking about corn, when we're talking about certain foods that you're able to trade. So that's what I wanna break down in this video. But the second reason, you should already know what I'm gonna say. The second reason is you are able to hedge your positions differently when we're talking about futures. Last video I talked about the micros and the minis, right? And how you're able to use that to kind of hedge your positions in a ranging way. It's different from options, but it gives you a little bit more leeway when we're talking about what you're able to do with your trades versus just being directional, bullish or bearish. Those two are what we're gonna break down in this video, so stay tuned. Boom shakalaka. Let's get straight to the charts right now, because today actually just ended up being a really good day for me. And the reason why I say that is because I was just telling you about corn and how it's been very volatile during the summer months, right? So right now I've been waiting for it to drop, especially to this extent, for a while now. So right now you're looking at a 5-minute chart, but I'm going to show you a 4-hour chart. So you can see this is a 4-hour chart you're looking at from October of last year, but let's focus on just the last month of May. This is what corn has been doing all of May. It's been literally on an uptrend since about actually April 25th, and there's been barely a retracement. I mean, it's been really crazy for anyone who was trading corn, especially bearish. You probably were in the negative for a while, to be honest, because of this trade. Now looking at corn, why has it been going up like that? Well, let's just go over to Google so we can look at some of the fundamental analysis behind it. Corn has been surging all of May, and it's because a lot of U.S. farmers have been struggling to produce the plant, and it's because there were a lot of flooding that was going on during May and during late April, and because of that, we've seen that in the market. So due to what's been happening with farmers, that's the reason why the prices have been going up, and we've seen it with several underlyings. Corn is just one of them. We could also talk about soy as well. Again, that just talks to the diversity of futures, but specifically focusing on corn because I was trading corn, I want to show you the trade that I took just last night. So because of all of this rallying to the upside, my fundamental analysis and then also looking at the technicals, I've been saying that corn just has to come down. It's broken a lot of resistant levels, but not only that, it's reached a 3-year high. And so because of that, we know that the market, it got to pull back some. We know that there's going to be some sort of retracement. And this is just the first red candle that we've seen on a 4-hour chart, so there could potentially be more move to the downside, but I just use this as a quick scalping opportunity. And so what I did yesterday, if I'm able to show you, I got in at 4:30 and I did a short call. So the short call side is on your left hand side, and at that time I got in right around here, and I believe I did 2 contracts. So if we were to do that trade right now, which I'm not telling you to do that trade right now, because again, options, futures, it has a lot of risk. I'm not giving you guys any trade recommendations. I'm just telling you this is what could have happened in the market if you were to take a trade in a paper trading account, because I'm not encouraging you to use your live money unless you understand this and unless you are familiar with futures trading and options trading, because there's a lot of risk that comes to it. Back to this though. So I traded at, I believe 430 was the strike price that I used, and I just did a naked short call on it. Speculatory, of course. I could have did a put spread to hedge my risk on the other side, but I was just doing this as a speculatory trade. So if we were to do that now, the cost, of course, is going to be very different because of the volatility that we're seeing, and then now especially to the downside. But you can see that one contract, 3 contracts of that would be a buying power. It would cost me about $1,900, meaning that's how much I have to have in my account. And the cost of the trade, the credit that I would receive is $1,800. Now, anyone who knows anything about options, this is amazing. For the buying power and the amount of credit you receive to be so close, that speaks to the volatility and the liquidity of corn. And that's the reason why commodities are just to die for, in my opinion, when we're talking about being able to trade based on liquidity, based on implied volatility. So that's corn. That's just one example. I did talk about gold as well. So I want to show you just what it looks like. Now, one thing I will say about some of the commodities is that there's not as much opportunity to trade it on a weekly basis. And so what I mean by that is that right now you're seeing that you have an expiration for July, August, September, October, November, December, February, and April when we're talking about gold. Well, there's underlines where you have a closer expiration date, and that's what we would call weekly options. Now, the reason why you like weekly options is because you're able to make that money on quicker. You know what I'm saying? Because there's a quicker expiration to it, especially when you are shorting options, not necessarily buying options, but when you are shorting options, we see profit faster. And especially for you Forex traders out there who are used to liquidity and volatility, that is always very attractive for you guys. This is just one reason why futures is sexier than Forex, is because you have the opportunity to say, hey, I want to have a little bit more time to be correct, so I could choose an expiration that's further away. For example, July 27th, or I could say, I want my money a little bit faster. I believe that this is going to move a little bit quicker. If there was a weekly opportunity for even going back to corn, I would have saw a substantial amount of money quicker. Let me actually show you the video. I think I screen recorded it on my phone. You could see here, this is when I was exiting the trade on corn. This was just around 10 o'clock this morning. Of course, I could have stayed in this trade. I just got out because I saw the profit. I believe I got out at $1,800 profit. And I was like, okay, this is speculatory, so I'll just get out of this trade because I don't know the fundamentals behind what's going to happen in the next coming days. But what I do know is I know the market has to see some sort of retracement level, and it's been rallying to the upside for a while now. So we're going to expect to see some down movement, and it just happened to be the day, Wednesday. This is a 30-minute chart again, just going back to it. And you can see from the opening of the market, well, futures, of course, trades 24 hours, but what I mean by the opening is the NASDAQ and everything else, the stock market. You could see 436 jumped all the way down to 412. Now, it did rally back up to 430, which is, again, a lot of volatility because corn moves $50 a point. And that's what keeps a lot of people away from trading futures, is the money that you have to have, the margin that you have to have in your account. That's where the micros come in. And if you haven't seen that video yet, go ahead and check it out. I uploaded it yesterday to YouTube. It talks about the new micro minis and how you're able to use that for futures trading as well. So I just wanted to show you the diversity as far as what you can do with commodities versus just trading currencies. Of course, I can pull up the CME website so we can go through some of the other underlyings that are involved with futures. So you just go over here to the trading tab and you can see corn. Of course, that's the one that's been very volatile. Soybean, I mentioned that. Oil, I've talked about that. Natural gas. Of course, you have the S&P as well. You can see this is the E-minis, so the micros haven't gotten up on this tab yet, but then you also have the euro and you have the bonds and gold. So those are just some of the underlyings that you can trade. If you want to visit this website, it's cmegroup.com. They're just one of the very well-known groups that you can go look at if you want to find out more about the global market companies and what they offer. So I definitely advise you to check that out, right? So the second thing that I talked about that I wanted to mention as far as when we're talking about why is futures way sexier than Forex, well, the second reason that I mentioned is that you're able to hedge your risk in a very different way. Now, specifically just taking a look at corn here, if I was trading future options and I wanted to trade corn, well, as you can see, wait, I didn't want to make this. Let me delete that. As you could see the volatility, right? What would I do in this trade if I hadn't got out of that short call? Well, I would have stayed in at 430, which is where I got in, and I could just do an opposite position to hedge my risk. So I had a short call on in this position. Well, I can then do a long call, which is me buying outright saying that I believe the market's going to go up. And all that's going to do is that if the market does continue to rally against that bearish position, then I'm able to hedge my risk a little bit. Now, it does limit the profit that you're able to make. However, it also limits the risk. So for people who may be a little bit more risk averse, that would be a good trade. Now, what I'm going to do actually, because I want to continue being in speculation mode, is I'm going to put on a trade here for you to see. So we're going to look at the charts together right now. Again, looking at corn. 419 is where we're seeing the market trade right now. Now, let's say that I believe that the market is going to continue this bearish trend. So I want to do a short call in this position, and I'm going to buy at the money. So right now we're trading at 419. So I'm going to go over to 4 right now. So these are the strikes, and you can see they're about 5 apart. So if we wanted to trade in the money, if I wanted to buy a short call, right now this is telling me how much it's going to cost me, or rather how much I'm going to receive from this trade. So I'm going to go ahead and use the 420 strike price. That's the sell call. I'm going to jump this down to 2 contracts. Let's make it 2 contracts. And let me save this one because we're actually going to do a multi-leg strategy, which means I'm not only going to do a naked strategy, I'm going to put on another one as well. So we're going to do a short call at 419, right? And then so I want to do a long position to hedge my risk to the downside. So let's say that I believe that corn is going to, it is going to rally above, I could do a straddle in this case, and a straddle would be buying at the money, saying a short call and a long call at the same strike price. You can do that. However, that's not what I'm going to do in this trade. Rather, what I'm going to do is I may actually buy out of the money and do a long call there. So 400, let's take a look at that. So right now, if I were to do a long call, and it's very important to look at the math of this, because you want to make sure that the credit that you're receiving, while it may be less than what you're buying outright, that you don't always want that to be the case. So being that I would be collecting in this case at 15.75, I'd be collecting $1,566. I want to make sure that the money that I'm paying out, the premium that I'm paying for my long position, even though it may not match that, that it's not too far away. So going back to the chart, this is really good for people to understand when they're trying to pick their strike prices as well. 415. So I actually think I'm going to do at 415 a long call. So that means that I'm going to pay about 18 for that. We're going to drop this down to 2 contracts. Actually, I'm going to do 1 contract. So I have a little bit more of a direction there. And let's see how much that's going to cost. So right now it's saying that for my sell position, I'm going to still collect $1,500. And then for my second position, I'm going to pay out $916. So that means that the buying power right now is $694. Not too bad. So let's put on this trade. There we go. And we got filled. So leaving you with this trade right here, I'll probably check up on this either on Instagram, so you can follow me on Instagram to get the latest updates on this trade, or maybe I can do a video on it if I don't exit it in the next three 3 to 4 days, even though I have a longer expiration. This expires in July. So that's just the first thing that I wanted to talk about. So you can see that I hedged my position by putting on a long call against that short position. So now we know that what we're basically saying with this trade is that I expect it to continue to rally to the downside. However, to hedge my position, I also have a long call at that 415 strike price. So hopefully that makes sense to you as far as the trade that I did with corn, the reason why diversity in your portfolio is important, and why futures allows you that sort of diversity. That's something that Forex doesn't, because you're only trading currencies, of course. And then also the ability to hedge your positions when we're talking about future options. So until next time, make sure you're talking options, guys. I'll see you later.